Okay, can you hear me? Good afternoon and welcome. My name is George Badejo Adebenga, and I'm privileged and of course delighted to facilitate a panel of experienced great minds within the finance sector, right? This panel was craftfully put together to discuss the cost of living crisis and how businesses are dealing with the situation. The question we're addressing today is whether the dam has broken. It is important to note that this isn't the first time the UK economy has faced similar crisis and managed to bounce back. Historically, in recent times perhaps, crises like the 2008 financial crisis saw the UK economy GDP shrink by 6% between 2008 and 2009. This led to a significant government intervention and a slow recovery. Another notable event, perhaps before I was born, was the 1970 oil crisis, which caused inflation to soar to over 20% in 1975, resulting in a prolonged economic turmoil before stabilizing in the 1980s. Currently, the UK inflation rate stands thankfully at 2.3% as of April 2024, a significant improvement, I must add, from the recent peak of 11.1 back in October 2022. This reduction, thankfully, was driven by the fall in energy prices, amongst other factors. Today, we'll be hearing from our panelists the impact of the current cost of living crisis on the businesses and customers, but importantly, how they've been dealing with the situation. I hope you would all take something away from this. Without further ado, I would invite our panelists to introduce themselves briefly and also indicate whether they think personally that the dam has broken. Perhaps we start with Nick.
Hi, I'm Nick Larkins, Head of Collections and Recoveries at HSBC. I also look after credit risk oversight. So I work in the second line and I own our customers in financial difficulty policy as well as our customer engagement strategy. Has the dam broken? No, I don't think it has. I think the conversation that we should be in is one of normalisation. And I think that as we start to see any increases in arrears, we need to look back further than pre-COVID and look at what the levels and the world looked like then and not just measure it against the last year.
Thank you. Chris.
Chris Laverick from NatWest, so I'm responsible for anything that's post-default across the group. So that is our retail franchise, commercial and our wealth franchises, and that includes all third parties and debt sale. Has the dam broken? No. Very similar view on this. I think there are some cracks in the dam and the water's trickling through, but I don't think it's broken.
Thank you, Chris. Robin.
Hi there, I'm Robin Griffiths, Head of Debt Recovery Analytics for TDX Group, the debt services division of Equifax. I've been at TDX for 9 years now, originally joined there to look after the performance of our government portfolio, but then over the years my remit has expanded to look after private sector as well, so across telcos, utilities, financial services, etc. And also have a customer experience team working with me who look after the content of communications that get sent out to our end customers through our debt collection agencies. I must say it's quite a relief that when you asked the question, has the dam broken, that I got 2 no's before it got to me because I feared I was going to give a different answer, but I didn't. I agree. I don't think that the dam has broken yet either. I think I'm in the same camp as these 2 guys. You know, you have to look at that longer term view as to where we were 5, 6 years ago. And yes, probably is now versus a year ago a greater weight of water pushing against that dam, to strain the analogy, but I think it's just about holding firm at the moment.
Excellent, thank you, Robin. Why don't we stay with you on our first question, considering you have a very holistic view of the entire industry. From an economic context, how has the crisis impacted consumer borrowing and repayment behaviors? And are you seeing an increase in defaults or late payments?
Yeah, so I think it's kind of building on what it seems like Nick is seeing as well, and some of the comments that you were saying there, Chris. You know, with being part of Equifax, we have the benefit of being able to see the wide set of bureau data, and across various sectors, we're seeing kind of worsening trends, but those trends in general are coming from what was quite a good place compared to 2019, say. I think during the pandemic period, a lot of people took the opportunity to sort their finances out. I know there's people in my team at work who said they realised they hadn't watched Sky movies for about 3 years, and kind of they suddenly had the time to think about that and change their subscriptions, etc. And or people, you know, there wasn't the opportunity for the discretionary spending, and people took that time to consolidate their finances. So a lot of indicators got a lot better during the pandemic period. We've seen that worsening trend over the last couple of years. You see some big headlines in the news about the energy price cap going up. Now, because the cap has gone up, that doesn't mean that people are necessarily using all that energy, spending all that. Of course, their balances are going up, but actually that first winter in 2022, I think a lot of people changed their behaviours, so weren't actually using as much energy. I know when we've had online meetings, you'd see people sat at home with 2 jumpers on, as opposed to the previous winter, they were there in their t-shirt and flip-flops with the heating on. So, you know, people had changed their behaviours in order to kind of combat some of the inflationary pressures that they were feeling. Now, we've seen utilities balances as they come into recoveries now, they have kind of ticked up in the first part of this year, as I think the people haven't got as many options to change their behaviours now, and there is still those higher energy price caps, which means those higher balances are coming through. Hopefully we're starting to turn a corner on that though. In other areas, so in the mortgage world, yeah, there's been a drop-off in mortgage originations, particularly with the high interest rates at the moment. We've seen average repayment amounts going up, but people are, again, changing their behaviours or changing their products in order to manage that. So we're seeing people extending their loan terms in order to keep their monthly obligations slightly lower. But we have still seen that go up from something around £600 a month to approaching £1,000. That's kind of leveled out a bit now, and again, as the interest rates hopefully will turn a corner, that situation will improve. We've started to see arrears rates increase in mortgages. They've kind of gone beyond pre-COVID levels, but nothing too alarming yet. If we look at credit cards, in that world, again, slightly worsening trend, but it's not coming back to pre-COVID levels in terms of arrears. And actually what we're seeing is some customers who are in arrears are doing a better job of managing once they're in arrears and getting themselves back up to date. Particularly the 2 to 3 roll rate has been improving of late, you know, and particularly in a number of provisioning models, it's often that step from 2 payments down to 3 payments down that becomes the point that you think they're more likely that they're going to default than they're going to get back up to date. So it's encouraging that we're seeing some positive signs there. So overall, I think I'm saying that we're seeing some worsening trends. Yes, there's a kind of bit of pressure building, but with inflation coming down now and hopefully interest rates turning the corner, energy prices coming down as well, I think we've got that weight of water pressing against the dam, but the dam is holding firm just now.
Excellent. Thank you, Robin. We're definitely a resilient bunch. Now, over to you, Chris. What measures is your institution taking to support customers struggling with the rising cost of living?
Yeah, so we, during COVID, we put a number of measures in place to support customers. Some of those have been removed now. Many of them we've kept where we've been able to see customers actually benefiting from them. So we've got fee suppression for customers who are persistently in financial difficulty. So we've got an enhanced kind of suite of fee suppression for that. Interest-only forbearance, that's something that we've kept. And a combination of those two have helped about 200,000 customers last year go from kind of being in early stage arrears to your point, kind of 2-3, get them back into the good book. And we've lengthened our repayment plan window from 18 months to 2 years. So those are the ones we've kept. There are certain other ones that were less helpful for customers, and those have been removed. I think if you kind of then look at accounts that are going the other way and how we've helped support them, We've seen quite a big increase. I guess the context is we've gone from about 1,200 to 1,400 a month of debt advice referrals. So we've put additional funding into the kind of debt advice sector last year to the tune of about £3 million. So we've kind of got the people kind of going to good book, and then people going the other way. And I think it's just a more general point on how we've got better structured data in terms of spending trends. So through COVID, spending trends did change quite significantly. They have normalised, but you do still see a change in certain spending patterns. So for example, petrol, instead of putting £100 in at the pump, people are putting 250s in. So they're still spending the same, but their habits have changed. So we've got better quality data now than we did pre-COVID to measure those types of things.
Interesting. Do you have any thoughts on that same question, Nick?
Yeah, I think the point that Robin raised around a change in behaviour that Chris picked up on with the figures there is important. So one of the things that we've seen is through the support and the outreach that we've got in place is that customers are contacting us earlier. We do a lot in the pre-arrears, the early intervention space, and we use internal and external data and some of the spending habits that Chris referenced there to try and identify those customers that are in need of support before they move into an arrears position. So I think that is an important switch in trend. I like to think it's as a result of our early intervention strategy because I own it. But I guess actually if you think about what's happened beforehand, we've had the mortgage charter and payment holidays under COVID. And we know the experience in payment holidays was that they were taken by a lot of people that didn't need them. But what that did mean is there was an interaction with the bank and there was support from the lender. What we saw in mortgage charter, what we're seeing so far in mortgage charter is that it's being taken up at much lower numbers. And again, there are a lot of people who are either not necessarily needing that, but using that maybe to rearrange their finances. But I think the takeaway is they're interacting. And if they get into a position where they're in financial difficulty or are worried about it, then they'll get in contact.
No, that is key interaction. No matter what, is always of great value. Now I'm just going to put a follow-up question to you, Nick. And this is looking from a social ethical consideration. How can financial sector better educate and empower consumers to manage their finances? And going back to this engagement with them, how do you do it? How do you ensure they understand that this is important to them?
Yeah. Well, I think this speaks to the intro that we heard a few moments ago, actually. So there are a number of thoughts I've got on this. I think you've got to get the right formula of right customer, right time, right media, right message, right data. If you can get those things right, I think that's part of the sweet spot. I think you've got to make barriers, you've got to remove barriers to engagement. I think that's another real key. And I think it's about dealing with the now and about dealing with the tomorrow. So the younger, our future younger customers are going to be an important group to influence here. And one of the things that we're doing at HSBC is we've now developed a financial learning module as part of the Duke of Edinburgh Award, which will be available to young people. And we're also trialling, it's in pilot stage, so important kind of element of test and learn, but in pilot phase we're working with a local council to bring that learning module, a local government, to bring that learning module available to schools and to teachers. We already do, as a number of others do, go into schools to bring financial education. But then, on the guess a more radical side, when I think about the fact that I've got 2 teenage daughters who spend their life on TikTok or whatever else it is that they're looking at, I do wonder whether there's an element of influencers that might come into the thinking and how to get people a bit more engaged in understanding more about their finances. And I also wonder whether gamification might become a thing in financial services a bit more readily. It's not really something I'm close to, but I've also got two nephews who seem to be, always on the sort of gaming side. So I wonder if that might help.
No, that's very interesting. I'm very passionate about the education, especially starting from the elementary stage. By the way, I wrote a book on financial well-being for kids, so you could access it by just going to www.thecoinquest.com. It's freely available, and it's pretty much going to that particular point, trying to provide children the foundational knowledge about finance, because when they understand it at that base level, it's easier for them. I've kind of lost hope on adults, to be fair, and trying to get them to understand finances. Excellent. Now, let's go straight back to Robin, perhaps. Now, how are you ensuring, from your perspective, that information is shared across all finance sector about what goes wrong and where the failures are, so that they can kind of improve whatever needs to be done to ensure firms understand their customers and they understand where the pressure points are?
Yeah, I mean, I think that's a very important part of the kind of collections and recoveries journey, is making sure that the data is flowing all the way through that journey, particularly if you're in the world where you kind of do some in-house collections, and then you might actually outsource that. And once you have outsourced it, does it go to more than one debt collection agency, say? So making sure that there's that flow of data there is important. And, particularly, we haven't mentioned vulnerability yet during this session, but that's a key part. When we're talking about consumer duty and outcomes, etc., vulnerability is definitely a key part of that. And that kind of probably touches on the importance to get in contact, but also the importance of having the right channels for contact as well. Because I think there's a lot of emphasis is put on, can we identify vulnerabilities so we can treat those customers appropriately? But actually, they can self-select to treat themselves appropriately if you're giving them the right channels. Maybe they don't want to interact with a person on the phone, but you give them the digital channel. They maybe don't want to disclose their vulnerability either. By having all those channels available and the right data available, you can actually still fulfill the right customer outcomes. But yeah, it's definitely important that in those kind of situations that you are aware of any vulnerabilities, any accounts that do move around, that information follows with them so they don't have to go through the process again and again and again.
No, that's very, very interesting. Now, going to Nick, on the point that Robin mentioned about consumer duty, I think it would be good for us to talk about that. How effective have the consumer duty regulation been in addressing some of the current financial challenges faced by households?
So I'm a big fan of consumer duty because I think what it does is it brings the conversation into alignment between all parts of your business, and it causes everybody to be looking and trying to answer the same question about customer outcomes, about foreseeable harm, etc. So I think that is helpful. I think if we go back far enough to sort of early 2022, that's when you probably see most of the lenders starting taking more proactive action in terms of outreach to customers, webinars, self-help improvements, that sort of thing. Whereas consumer duty final guidance came in the summer of 2022. So I think important to note that lenders were already on that, thinking about that, taking proactive action. But yeah, it's definitely shaped the conversation and thinking since. Where I think it's made a real difference is probably best illustrated by the UK Regulators Network letter that landed in March this year, because it covered for me the regulators that represent all of a customer's financial position. When someone's in financial difficulty, it isn't just about their credit card or just about their mortgage, etc. It is about their utilities and the whole financial picture. So what I saw in that UK Regulators Network letter was all of the regulators were focused on consumer outcomes, they were focused on standards. So I think consumer duty seems to be leading the way in regulatory thinking, and I think what that really helpfully does is it puts on the table the opportunity to open the debate about how free debt advice is funded in the UK. So I think for that reason, it's very helpful.
Awesome. Chris, do you have any thoughts on this one?
Yeah, I mean, I kind of echo Nick's point. I think there's probably two builds. One is certainly from a collections and recoveries perspective, consumer duty was a massive thing, and for everybody, I know put a significant amount of resource to it. But actually, once you kind of peel back the layers, there's actually not a huge amount of change in the collections and recovery space. Certainly from our perspective, there's things that we need to do better for sure. But it's certainly not as big and complex as we'd perhaps envisaged when it was kind of announced. So, yeah, I think we were, from collections and recoveries perspective, in a very good place because it was very much focused on outcomes already.
Mm-hmm. That's good, and very good outcome, very good timing from the regulator in that regards as well. I think it was just perfect. Now, let's do some questions on Slido. The top one, how many consumers are about to come off long-term fixed mortgage? Will they have prepared for the hikes? And I don't know, perhaps Robin, would you have any?
Yeah, I don't know the exact proportion off the top of my head, but I think we're in kind of there's a lot of them about to come off for long-term fixed rate mortgages. I mean, in the bureau data, we can't see exactly when loan terms are due to finish, but we can kind of extrapolate from seeing a constant payment and when those constant payments started. So, you know, the typical loan term is 2 years, 3 years, or 5, and you know there is going to be a high proportion rolling off there. In terms of how people are prepared for that, so I mentioned earlier that people are extending their loan terms in order to prepare to manage their monthly outgoings. You know, and actually 41% of mortgages, I think it is at the moment, are due to mature when the mortgage holder is of retirement age, so 66 or older. And I think it's about 13% for customers who are going to be 70 or older. You know, and there's some pretty scary percentages. So, you know, I think what people have done is try and extend those terms with a view of do they go on to a 2-year or a 3-year now, in the hope that the interest rate has come back down in those 2 or 3 years, they can bring the loan term back in. Now, whether that happens remains to be seen. But that's also not an option that's universally available, because if you then break that down by age demographics, you can find that actually it's only younger consumers who can extend that term, because understandably, lending institutions are probably a little reluctant to extend terms for older customers. So there's only so much you can actually do with that mortgage term. The other, I don't know, it's a great white hope, but you know, hopefully the energy prices are coming down now. So if we've established a new kind of normal of outgoings on energy, hopefully that will provide a little bit of a buffer if people are rolling off mortgage rates.
Okay, excellent, thank you.
I'll probably just build on that, just
yeah, sure,
on the second part of the question. So certainly in the mortgage space, there is almost a generation of customers who, when you talk to them about the mortgage payment going up in line with interest rates, that's an alien concept to them because we've had such low interest rates for such a long period of time. So will they have prepared for the hikes? I think there's a yes and no answer to that. The yes is, if you then look at set deposits in conjunction with the question, then you could probably argue yes. But when you speak to those customers and the concept of an increase in CMI on a mortgage is alien to them, then that's quite concerning.
Mm-hmm. Yeah.
George, could I just add one other thing on that?
Yeah, sure.
Will they have prepared for the hikes? I'd probably ask ourselves as lenders the question, have we done enough to help them prepare for the hikes? So I think, again, that's back to proactive outreach. I think that's back to education. I think that's back to the roll-off journey. So we're tracking the customers that are rolling off fixed rates very closely, as you can imagine. And we're really pleased with what we're seeing. People are making changes to accommodate their financial position. So I definitely urge people to think about what part they play in the lead up to that roll-off.
No, that is awesome. I don't know how we're doing with time. Are we okay? So let's round up then. I think you've pretty much covered most of everything. It sounds like, yes, there are cracks, but the dam isn't broken. And if you think it's broken, it's repairable, right? And we have to work collectively together, whether it's government, regulators, consumers, and businesses. Ladies and gentlemen, our brilliant panelists, thank you very much.